I help people not pay taxes by owning real estate.
They're sitting on six-figure tax deductions.
It becomes a very fun topic when they realize they're going to save $500,000, $2 million on their tax return.
There's tax fraud, and then there's tax code, right? You know, a lot of stuff you see online is just straight up tax fraud. But things like cost segregation are not.
So what I refer to straight line is your dad's way of depreciating property.
Mm-hmm. Right. So I just saved 75 grand off my income tax.
Unfortunately, not only can he not do that, it's illegal. And then another thing on the short-term rental, it is 100% not a loophole. It is a pitfall. It is a trap. And if you hear some real estate broker telling you on TikTok that you need to buy your Airbnb,
Don't.
And just know that there's more than 40 states at this point that are harping down on Airbnb regulations because the short-term rental market is trash.
It's a lot more work than you think it is. And to Justin's point, it's like you're usually working at the same time and you don't realize you just picked up, you know, a small hotel to manage.
But this is now the golden age of tax mitigation in real estate. This is the time to buy properties, cost seg, do 1031s, build that tax can and kick it down the road, and really build a portfolio for yourself and make your money work for you right now while interest rates are high and you need cash on hand to make cash.
Is like cost segregation is great, but the bonus depreciation side of this stuff is really interesting.
Extra 400 grand. So I paid an extra 7K
Crazy.
to keep an extra 400K.
Yeah.
It's pretty good.
If you bought a property after January 19, 2025,
Right.
that 100% bonus could be eligible to you or is eligible to you. Welcome to Unlock Your Passive Lifestyle podcast. I'm Tommy Thompson, and I'm joined here today with Justin Kiehne. We are talking about today cost segregation. Most investors don't have any idea they're sitting on six-figure tax deductions. So we're going to dive into one of the most powerful tax tools you can tap into, cost segregation, with our guest, Richmond Stacker with USA Cost Segregation. Here we go. Got my black jacket on today because we are diving into taxes and the tax code. Man, we have such a great session lined up today. We've got the exhilarating topic of cost segregation. We have Richmond with USA Cost Segregation, CEO, founder. I'm so excited for this today. Richmond, you came into town, drove all the way from Carolinas to be here. And I always think it's interesting because this is like one of my favorite topics and so many people don't know about cost seg. A lot of commercial real estate investors that have been investing forever haven't used cost seg. But, you know, before we get into all the fun stuff, it's like, you know, I wanted to ask you, if you're at a cocktail hour and you're meeting people and you're telling them what you do, how do you explain cost segregation at a cocktail hour?
Well, I'll tell you, Tommy, I usually don't hear the word exhilarating and cost segregation tied together in one sentence. So it is nice to hear, and I really appreciate it, which is why I don't really get into the details in a cocktail conversation of cost segregation. I just cut it down to the basic facts. We are going to do an engineering study on a property. We're going to separate all of the assets in that building into their useful class size, or I should say the appropriate categories, which is slang for we're going to depreciate it faster than it was depreciated previously, and we're going to save you money on taxes. And that's it. And then we're going to use an engineering study to back it up with the IRS. And that is the paper napkin, if you will, of cost seg. Most of the time, it's not an exhilarating topic at the beginning. It becomes a very fun topic when they realize they're going to save $500,000, $2 million on their tax return. That's when you get into the nitty gritty and the fun stuff.
You show, you know, how that extra depreciation translates to specific deduction, right? Specific income tax savings.
100%.
And that's like what, so if someone was very interested at a cocktail party, right? You'd be like, I save real estate investors money on their taxes, right?
My one-liner is I help people not pay taxes by owning real estate.
Yeah. I find that, Tommy, I don't know about you, I find that sometimes I have a hard time explaining what it is that we do as well. I'm like, yeah, I'm in commercial real estate, but I'm in taxes. I'm not a CPA, I'm not a commercial real estate broker, right? You're like, it comes down to just articulating the benefit.
Exactly.
What do? I help people defer capital gains tax liability, right? That's what we do with 1031s and similarly, right? But you're a little different in terms of the clients that you work with because you're working with people that own real estate directly.
Exactly.
Right? That are involved actively, fee simple. But cost seg is interesting because it's a new type of depreciation, right? It's a specific type of depreciation, right? Bonus depreciation, cost segregation studies. Talk about sort of straight line depreciation. Like if somebody doesn't do a cost seg study,
Right.
how does depreciation come into play with the real estate, the investment real estate that they own?
Right. So there, you have straight line depreciation, and then you have what the nerds in my industry would call the modified accelerated cost recovery system, MACRS, if you will. And so what I refer to straight line is your dad's way of depreciating property, right? So what they're going to do is based on whether or not it's residential or commercial, is whether or not it's 27.5-year straight line or 39-year straight line. And what that means is quite literal. So it is literally 39 years divided of your basis, and you take that deduction 1/39th each year, minus land, of course, because you can't depreciate land. And then same thing goes for residential real estate. At 27.5 years, you're taking 1/27.5 of the basis in depreciation each year. But whereas cost seg separates that long-term property, and for everyone that's listening, when I refer to long-term property, I'm talking about Section 1250 property that is depreciated over 27.5 years as residential or 39 years as commercial. That is the straight line depreciation, and that is long-term property. In cost segregation, we're separating the short-term assets in the building and outside of the building into either 5 or 15-year class lives or 7-year for furniture and fixtures and equipment, FF&E for all of you real estate brokers. And we're separating that out, and it's getting depreciated into those shorter periods. So now it's 1/5, it's 1/7, it's 1/15, as opposed to 1/27th or 1/39th. Then with the new regs, and I'm guarantee everybody we will get into this in a moment, with bonus depreciation right now, we're taking 100% of all of the 5, 7, and 15-year property as a deduction in the first year. So it's a huge benefit to anyone that owns commercial or residential investment real estate that is looking to mitigate taxes and has a burden to get rid of.
So you're effectively, to put it in layman's terms, you're front loading depreciation. You're taking a larger share of that depreciation that you would take over 27.5 years or 39 years. You're taking a larger share of that, especially in bonus depreciation in the first year, right? So that is kind of the supercharge is, it's like break that down specifically, like using numbers, right? So let's say somebody goes out and they buy property for $5 million, right? And it's I'm going to expose my ignorance here, but let's say it's a warehouse, or it's, so it's commercial, right? So it's 39-year property, right? And $5 million, and there's a way of determining or allocating what portion of the value is attributable to the property, the improvements, the building, and what portion of the value is attributable to the land.
Right.
And land is non-depreciable. So if we want to maximize our depreciation, right, that deduction, which translates to an income tax saving. Right. If we want to maximize our depreciation, we want as high an allocation to the building, the improvements, as possible. Right? So in this example, let's say $5 million purchase, let's say $1 million is the value of the land, $4 million is the value of the improvements, right? If we're doing that straight line depreciation, 39 years, you are depreciating 1/39th of $4 million each year, right? And that's, call it a little bit more than 3%, a little bit less than 3%, whatever that is, right? Versus having an engineer coming out and do a cost segregation study. So, what's, 3% of $4 million is maybe $120,000, I think, off the top of my head.
Well, and if you'd like, let's break it down into like some super easy math real quick.
Yeah.
So I've got a $1 million building, or my land value is $200,000, excuse me. My base is $800,000. Out of that $800,000, my deduction under straight line depreciation is going to be roughly $22,000. So that times my tax rate is going to be what I'm actually saving.
So if I make $1 million a year in income and I can take a $22,000 deduction, my taxable income is now $978,000. Right? So that's not a huge needle mover.
It's pretty much chump change.
Yeah.
So if we take that same $1 million building with a $200,000 land value, $800,000 basis, and we do cost seg, let's say we're hitting around 30 to 40%, you're in the range of $120,000 to $220,000 in depreciation. So that's what, an 8x, 9x. It's a huge benefit.
So same. All right. So $200,000 deduction versus the $22,000 deduction, right? So now my $1 million income, now I'm only taxable on $800,000 of it.
Exactly.
Right. So
you take everything as a net operating loss.
So my actual savings right? So if I'm in a 37% tax bracket on my $1 million, right, I pay 37 cents on every dollar I earn.
Exactly.
So your actual savings is that 37% times that $200,000 deduction, which is $74,000 or something
Roughly.
similar off of my income taxes, right? So I just saved 75 grand off my income taxes,
as opposed to 7 or 8 at 22,000 in deductions. So huge benefit. But as you know, we can all do the math here. The larger the property, the better the deductions are going to be. So that's kind of where we come in and we take an advisory position on that. So for instance, if you come to me and you have a $200,000 property that you bought in 2005, I'm going to look you dead in the eyes and say, we're not doing a cost seg.
Right.
You've depreciated most of it.
Yeah.
19 years of depreciation. We're not going into that. There's not enough to justify the fee. So it's the time value of money argument, but there's also a lot that has to do with recapture. And I want to come back to that later because I think it's a very misunderstood part of the cost seg.
Yeah.
And I'll tell you guys right now, I'm nothing like any cost seg guy that you'll ever meet because I'm going to tell you exactly what's going to happen on the back end. I'm going to tell you about the recapture, and we're going to approach it from a strategy. I'm not just going to say, hey, go buy a short-term rental. You'll be able to take that at 100% bonus on all the deductions and everything's going to work out great.
Well, that is something, though, we'll touch on that because there's so much talk out there on Instagram and online with influencers talking about cost seg and, you know, and all that stuff. And I want to get into that a little bit. But just to kind of go back a little because it was so interesting to me. When I found out about cost seg, this was so long ago. This was like 15 years ago. And I was working with a commercial real estate owner, and he owned a bunch of strip centers. And he did a cost seg study on a strip center that he had just bought. And the way that he explained it to me, he goes, Tommy, they come in and they do this engineering study and they break apart the entire property. You know, the wires in the walls that go to the lighting have a different depreciation schedule than the foundation on the property and the air conditioning units. Can you just talk about that, just kind of layman's terms, like that engineering study that's performed and how different things are depreciated on an accelerated basis, like an air conditioning unit depreciates faster than the foundation on the building?
Yeah, and this is another area that's highly misunderstood, and I think it's really important for investors to understand what goes into the actual engineering on a cost segregation study. You know, I'm not here to name names or drop any bombs, but there are a lot of firms, and there are a lot of CPA firms, unfortunately, even the higher level ones, that are outsourcing this work, or they might third party it to, you know, a cost segregation firm, but the engineer ends up being an actual landscaping architect rather than an engineer. So when we look at the engineering, you have to understand at a very quantum level that, or I should say molecular, everything that goes into the electric, the plumbing, the land improvements, asphalt, grading, all of that is in the cost. So, and when I say in the cost, a lot of people are going to be like, well, how do you know what it costs to grade this property? What did it cost to lay the foundation of this? And because mostly we work with acquisitions. Now, new construction, great. We have blueprints, we have cost construction plans. That's awesome. But 90% of the time, it's going to be an acquisition. So
somebody's buying, and then they're bringing you in to do a cost seg study.
Right, exactly. And we don't have the building specs from 1990.
Right.
So we have to quite literally, and that's where the site inspection comes in. So you're going to have one of our engineers or one of our site inspectors, typically home inspectors is kind of where we hire out of. They have that direct profession. They know what to look for. But they're going in and they're painting a picture for our engineering team. And the engineering team is going to take all of that information with cost breakdowns, and they're going to count the lights, the windows, the measurements, you name it. And my engineering team is going to then go in and separate all of that based on a single methodology that our company has adhered to and adopted, I should say, that we believe is the highest standard in engineering methodology. So what that requires is not just an engineering expertise, but a dual understanding of the tax code in relation to cost segregation and the engineering that goes behind it. So, when you talked about electrical, lighting, plumbing, think about owning a restaurant. Yes, all of my beer taps, we're going to call that 5-year property. You installed it for the sake of doing business. But what about the refrigeration for my tanks, the plumbing, the electric that go to all of that? Because that electric and that plumbing wouldn't exist unless I had the necessity. So having an engineering team that's qualified and understands the property enough without literally taking a sledgehammer to your wall is quintessential because they have to understand how everything works behind the walls in order to write those off under 5-year property or 15-year property, whatever the actual asset is. But a lot of firms that I see right now, they miss that other step. They'll write off the beer tap, but that plumbing and electric, they're not going to get into that because they're not going to fully dissect that property.
And if you're missing on the plumbing and electric in this situation, you have less 5 or 15-year property, and therefore you have a lower deduction, right?
You're losing about 10% per million. So $100,000 per $1 million in basis on average if you go with what I would call spreadsheet cost seg provider.
So you're missing out on $1 million of acquisition price, right? You're missing out on maybe $100,000 of deduction, which again, if at a 37% tax bracket is a income tax savings of $37,000.
Right, it's not nothing. That's a year in college
And just going back to it too, it's like, at the cocktail hour, right? I mean, we have difficulty kind of explaining what we do sometimes, but we say, we work with CPAs, we work with attorneys, we work with commercial or investment real estate owners that have highly appreciated real estate, and we help them with tax strategies, right? With you, it's like, when I first learned about cost seg, it was so interesting to me. I thought the people that were doing the cost seg were CPAs. You're a great sidecar to a CPA firm to build a lien on when they have a client that just bought a strip center or a warehouse building or whatever it is, and they have a high basis, they call you and you do the study because it's an engineering study. It's not CPAs that are doing it.
That's correct. And I think that is one of the biggest misconceptions of cost segregation is that, my accountant will handle that.
Yeah.
Your accountant is not an engineer. Unfortunately, not only can he not do that, it's illegal. So you have to get in a cost segregation firm that has qualified engineers to do any of this work. If not, you have a CPA that might just be shooting in the dark or throwing spaghetti at the wall to see if it sticks. And if audit time, and I hope it doesn't for anyone that's listening, but if that happens, you have to be ready for the questions that will come after, which is, how did your CPA get to these deductions? And if it's anything short of he hired someone to do a cost segregation study and they were qualified engineers and here's the final report, you're not going to have the best day.
And if somebody buys like a property in like September, right, of 2026 or whatever, how quick can you turn around a cost seg study like before the end of the year? Like how long do these take to do?
So I would say we're dangerously fast.
Yeah.
And for a reason. And I'll just give a few examples. So typically it's going to take your average cost segregation firm 3 months on average. I'd say you're lucky at 2 months. And that's also based on the information you provide, how fast you provide it, and whether or not they follow up. With us, we have an entire checklist of the things that we need from our clients. We take all of the pressure off of the client and we go direct to CPA. We say, we'll get this directly from your CPA. If your CPA doesn't have it, unfortunately, you're going to have to talk to us. And we're going to need that information. But we're going to press really hard to get that within 2-3 days of signing the engagement. After that, my entire team has a 3-week deadline. If it's not done in 3 weeks, it is not going to be a great day. And that hasn't happened yet. We've never gone over 3 weeks. But we can do it in as short as 4 days, if absolutely necessary. So wow. I'll give you a very interesting and fun example. We had a study in which we found out, we did the whole study, and it was for a partnership, and they had K-1s to give out and everything. So, we were trying to get it in, and we had about a month. And we were trying to get in contact with CPA, couldn't get a hold of them, and we hear it on Tuesday. Wednesday's the deadline. On Tuesday at about 3 o'clock, we get an email from the CPA and says, I filed the return and we forgot to tell the partners. So now we have to file a superseding return with the correct depreciation because it was in the same purchase year. This is 25. This actually happened. I think it was October. Yeah, it was. And our engineers worked overnight. We filed an amended return, redid our engineering, fixed the basis, and we had that return out within 24 hours.
Wow.
Listening, please don't do that to me.
Yeah, we always say that too. So we joke around. We said this in front of a room full of attorneys and CPAs. We said we love complicated deals. And what do we get after that? A bunch of complicated deals. Yeah. But, it's interesting to me because I don't know if it's my algorithm on social media or whatever, but I hear all these influencers talking about cost seg and, using it towards your income and buy a rental property or an Airbnb or whatever it is. What is, and this can be specific for you, but it can also just be in general. You mentioned don't do it on like a $200,000 property or something like that, or maybe, 250 or 300,000 might be too low. What's like the threshold? Like when you get to a certain property value, when does it kind of start to make sense to look at a cost seg study?
I would say anything over $500,000. We can get a little bit more granular and go to 300,000, but then it's time value of money and what are you going to actually do with the savings? And so I always try to be extremely transparent with my clients. We are saving you money from the tax man. What you do with that is what makes it worth it, right? So if I save you $200,000 and you go buy a Ferrari, well, you just bought a depreciating asset, and now we're in a whole new area of ignorant finance. But if you take that $200,000 and you put it in sponsor me, Vanguard, and looking for it, then you might make 9 to 12%, and you're going to be doing better off if recapture comes around, or if you don't handle the transaction through a 1031. And I see you itching on it. And
well, no, that's the magic. That's the magic term is recap, because there's no such thing as a free lunch, right?
Right.
And so, Tommy, you said it. The tax savings, the go buy a GY, deduct it. Instagram finance influencers.
Get that 179D.
Yeah. Love to talk about these gotcha, loophole, whatever. There's tax fraud and then there's tax code, right? A lot of stuff you see online is just straight up tax fraud. But things like cost segregation are not. Now, the IRS does not give you that deduction for free. There is recapture, right? And you alluded to it. Talk about that and what that does to, what that does to folks, I guess, on sale, right? And then how you guys strategize around that.
Yeah. And so, well, if you don't mind, before we get into recapture, I want to address the short-term rental.
Okay, sure.
Because this is the Instagram, TikTok, loop-de-loop is what I would call it. Always consider who's actually selling you these products, ladies and gentlemen. They're not cost seg guys. They're real estate brokers. And what do they want you to do? They want you to buy property.
Or they're selling you a course, or...
A course, of course.
Yeah, of course.
So here's the thing that people don't understand about the short-term rental gig. One, there's so much inherent risk, right? You're talking about a 7-week period of your rentals. So a lot of people go, oh, well, short-term rental, so I'm going to put it on Airbnb. If you click over 7 days, it's immediately not a short-term rental. Boom, right there, you're done. 2, they'll say, this is the trick to get around the material participation rules for a qualified real estate professional. And for those of you that don't know, there's qualified real estate professional status, or they just call it real estate professional status. It's when you contribute 550 hours or more, or there's the 50-50 test. There's a couple different measurements that we can get into that would let you take these deductions off your W-2 income, ordinary income, rather than just passive income. For most people that are going on this short-term rental journey, they are not actively participating. The whole reason they want to get into it is because they don't think that they have to. Well, that's not true. So there's what's called the 100-hour participation test on short-term rentals. You have to contribute 100 hours to material participating in that property each year for it to qualify as short-term rental. But here's the kicker. You have to be the only one that is committing that much time. If you hire a property management company, and they're going to definitely do more than 100 hours per year, you automatically DQ yourself.
Right.
So most people don't understand that, and they come to me and say, hey, what if I bought all these short-term rental properties? Well, before we get into any, depreciation risks or the market risks that go into having that, if you're not participating 100 hours, then you're done. If you are participating 100 hours, but you have a property management company, you're probably done. So it really doesn't work. And you're adding a lot of risk. And that's without the taxes and insurance that come along with having a short-term rental, the damages fees, you have so much more damaging events.
And the needle that you're trying to thread here, right? But that is the needle you're trying to thread allows you to take that deduction against your active income.
It does.
Right?
It
and
does.
these are typically business owners or W-2 employees who have full-time jobs who are looking at this short-term rental loophole, as they call it, as a way of offsetting their other income. They are successful in their day job. They are successful in their business. They probably spend a lot of hours working in their day job or their business. And so to add on additional responsibility for the sake of the tax deduction, when you consider these other risks, when you consider there is a needle that needs to be threaded, it maybe doesn't make sense. right? You're taking your eye off the ball.
You mean operating an Airbnb isn't like a mini hotel?
Right.
Typically
it's
not,
so much.
ladies and gentlemen.
You know, my parents operate some in upstate New York. It's a lot, man. My mom's been doing Airbnb since before it was Airbnb, it was vacationrentals.com. And it's a lot of work.
Right.
And to Justin's point, it's a great point. It's like, okay, well, you're a high income earner. That's probably why you're doing this. And probably why you're doing the cost seg study. How the heck are you going to qualify under this real estate professional threshold? It's tough.
Yeah, and typically you're not. But your CPA might not know those regulations, and there are a lot of companies that will sell you a false bill of goods.
Right.
Thankfully, we look at these situations as these people's lives are in our hands. It is a very real thing when you're filing someone's taxes and you have that responsibility. So please don't listen to the TikTok, the Instagram gurus of cost seg when all they do is sell real estate, because they don't do cost seg, they're not engineers, and they don't know the tax code. Always consult your CPA or me.
So now, and that's, I mean, you kind of hit it on the head. And that's bucket A, right? That's like kind of the influencer type thing. That's what everybody's talking about. Hey, go buy a rental property or an Airbnb or whatever and get the tax benefits. But a lot of the people we work with and you work with, they're like legacy real estate investors, right? They're buying the strip centers, the office buildings, the self-storage facilities or whatever it is. I mean, who's like kind of an avatar type of client that's good for something like this? Is it, somebody who's been investing in real estate for 5, 10, 15, 20 plus years, and for some reason they haven't done cost seg studies on their properties, which always blows my mind. We have clients that, have been investing in real estate 35 years and never done a cost seg on any of their properties. Who's a good avatar client? Is it somebody that recently just purchased it, maybe this year, within the last 3 or 4 years, and spends most of their time on their real estate portfolio?
Yeah, I would say the avatar client. So I get this question a lot. What is the best client for cost seg? I always respond with anyone that wants to pay less taxes. At the end of the day, let's be real.
Yeah.
If you own a manufacturing facility, you're going to have a lot of short-term property, and it's great if you personally run that business because we don't have to worry about passive activity rules.
Right.
If you're, and this is for any business owner that has not done a cost segregation on their property and they own the property. The entire reason you're not paying a lease is to take advantage of the tax mitigation strategies. And the number one on that list to start is cost segregation. When you hopefully sell that restaurant and make a huge profit, the next strategy is going to be a 1031 exchange, so you don't pay any of the capital gains tax and you move on into your hopefully great Florida retirement life. But there is no one-size-fits-all for a good candidate, but there is a one-size-fits-all for a bad candidate. If you already have losses, what are we doing, right? It's time value over money. If we're not actually going to save you any tax money, let's not do it. Number two, the individual who has a very complicated tax situation and wants to add 3 properties to their portfolio, and they're the first 3 properties, let's slow down a little bit. We're not going to get into advanced tax strategies your first year of property ownership. We might, but this isn't something you just full speed ahead, let's go. No, this takes your CPA, a professional in cost seg, to evaluate your holdings and figure out what's the best strategy for you. Because sometimes I will say you can do cost seg and you should, but that doesn't mean you should take 100% bonus, right? It's about leveraging your money into the highest tax bracket that you're going to be in over the next 5-10 years. So there's a million people that should do it. Actually, there is 7.8 million people that should do it. And if you're one of those 7.8 people listening to me right now, I highly encourage you to call us. But the people that shouldn't do it are the people that haven't thought about it.
Haven't thought it all the way through. It's not a part of a coherent plan.
Exactly,
right?
and it has to be.
And that goes back to the recapture, right? Because there isn't a free lunch.
It's an amazing circle back.
It was very well done. I'm impressed. There isn't a free lunch. Right. If you do the cost seg, you take the deductions. You're not in a high tax bracket where it really is a huge impact on you. Then on the back end, when Uncle Sam comes knocking and asks for his recapture, there was no real arbitrage, right? For the people that are in the highest tax bracket, that are paying 37% income tax at the federal level, plus potentially state income tax. If you can offset 37% income tax and then pay recapture maybe at a 25% bracket, like, hey, that is not only am I getting time value of money because I'm offsetting income tax today, paying recapture in the future, but I'm also doing an arbitrage.
Yeah, you're gapping that percentage.
37 down to 25.
Right.
Right. So talk about recapture.
Yeah. So, and this is probably one of the most highly understood areas of cost segregation and real estate tax in general. And, you know, I'd love for a cost segregation company to come up and show me their depreciation recapture calculator, because I don't think anyone has one except for us.
It's tomorrow's problem. We don't have to.
We actually just finished last week. So if you want to know what that's going to look like, please let us know. So when we're calculating recapture, we're looking at, and for everyone that doesn't understand how the basis works in a property. So let's say you have a $1 million property. I'm going to use round numbers just for the sake of being easy. You have a $1 million property. We're going to go back to the same example. 20% land, you have an $800,000 basis. If we do a cost seg and we, delineate, let's say $250,000 of your $800,000 towards short-term property, your basis has now been effectively reduced by $250,000. And people say, well, what do you mean by basis? Basis is the taxable value, but it's also the point of contention when it comes to capital gains. So you have your $1 million property, 800,000 basis, 200,000 land. We do a cost set. We allocate $250,000 towards short-term property. So your new basis is $550,000 at your point of sale. And what does that mean on the backside of depreciation, recapture, and capital gains? Is that, say I now sell that building for $1 million. So
you bought it for $1 million, sold it for $1 million.
Yep.
So no appreciation.
So this is what most people would think a non-taxable event, but it is very taxable. So the basis has now been reduced to $550,000. So now your capital gains tax is going to be $450,000.
Which is the $1 million sale price less the $550 basis, right?
Exactly.
Even though I bought it for $1 million, sold it for $1 million.
You didn't make money, quote unquote.
Right.
You did reduce your basis by doing a cost segregation study. Now, that's not a bad thing necessarily, right? And this is where the tax planning comes in. This is also where 1031 exchanges come in. So now I have a larger capital gains because of my reduced basis. So I got all this tax benefit, but now I have all this capital gains tax. What do I do now? Well, you take that capital gains, that $450,000, because we bought it for $1 million, sold $1 million, but we reduced our basis to $550,000 by allocating $200,000 to land and $250,000 to short term. So if you're tracking with us, I know this is a lot to keep up with. You can slow it down, but now we're paying a capital gains tax at 20% on $450,000. But nay, let's do a 1031 exchange. Let's put that $450,000 into another property that hopefully cash flows more, is not a short-term rental, and gets you out of a horrible recapture and capital gains position. So you take that money, you invest it into another property of equal or greater size. Right. And I'll let you guys speak to that. I won't get too much into 1031s. But then you've eliminated the recapture tax. You've eliminated the capital gains tax, and you keep rolling the tax bucket down. So there are two things that are inevitable: death and taxes. But if you use 1031 and cost seg the right way, you can make them happen at the same time.
So if you die, you don't have to worry about it.
Exactly.
Yeah.
Well, you can't take it with you, right? Or then, you put it in a generational skip trust, give it to your grandkids because your kids weren't that great anyways, and now they're not paying any taxes on all of your income.
And just to shift gears a little bit, and then I want to get into the one big beautiful bill and all that. But I mean, how Richmond, how'd you get into this? How'd you get into cost seg?
Like a mouse looking for cheese. So in 2016, I became a mortgage broker, and I actually moved down to this beautiful city of West Palm Beach. And I spent a lot of time in Boca, Fort Worth. I actually opened an office in Fort Worth. And this was right when mortgage was blowing up really bad. Quicken Loans, Rocket Mortgage. Everybody was realizing the old mortgage broker isn't that necessary.
Yeah.
And for me, that was news because I had just started.
Yeah.
And the test got a lot harder after 2008. Shout out to my boomers. You guys put us in that. And so I had to look for a way out. And I loved real estate. I loved everything about it. And I hated everything about taxes. And my father told me one time, he said, if you ever feel like you don't understand what you need to do for a living, pick up the tax book and learn how to manipulate it.
Wow.
And I took that to heart. And I learned about cost segregation through my godfather, who'd been in the tax industry since the early 90s. And I fell in love with it. And I just dove right in. And I started my first cost segregation firm in 2018, designed my first proprietary cost segregation software in 2019. And I really never looked back.
That is such a good quote. I love that. And I mean, that's another thing that you get kind of, targeted online about is, hey, read the tax code, right? I mean, it's there for a reason. It's a roadmap for a reason to be able to save you, money in different ways. And it also employs people in different ways too. But that's a good kind of segue, because I know you were talking about this is, the tax code. Why is cost segregation a part of the tax code? This isn't a loophole. This is a part of the IRS tax code. Why is it there?
Right. And so this is, and thank you for bringing this up, because this is something everybody should understand. Because people say, oh, well, cost segregation could come and go. Let's all be real with how cost segregation got here. The Hospital Corporation of America sued the IRS in 1993, and they won and created the Modified Accelerated Cost Recovery System, MACRS. And it allowed taxpayers to separate their assets into short depreciating. And when I say short depreciating, I should say appropriate class lives.
Sure.
And the argument for the Hospital Corporation of America was, hey, listen, we have all this equipment that it has to be replaced every 5-6 years, but we're not seeing the benefit of those deductions until 39 years. It just really doesn't make sense. Right. And there was a version of this in the late 60s, but it wasn't concrete. And then even after the Hospital Corporation of America won their lawsuit against the IRS to create all of this, it wasn't until 2004 that the IRS created any audit techniques guide or gave instructions on how to do it properly, right, as is tradition for the government. And we're at a very big turning point in cost segregation, because the first and last, up until this past year, audit techniques guide, any instruction that we got from the IRS was in 2004. It wasn't until the OBBBA that we got a new, I think it's 246 pages of guidelines from the IRS to
get that memorized.
Yeah, probably, quite literally, but to amend the previous regulations, because we have to change some things. And there was minor changes in 2017 with the TCJA. For those that don't know, the Tax Cut and Jobs Act that Trump first passed in his first term of office, that reenacted 100% bonus. We went from 50 to 100% on bonus depreciation. A lot of awesome things happened with, technical corrections to qualified improvement property. And we've seen that trend continue. And the reason why I give this entire background is so people understand this is something that has been fought for tooth and nail with litigation against the IRS and coming up with W's. So the argument of, will this be around to last? Will we be able to do this forever? The answer is yes.
On top of that, I'll say, people use the term loophole, right? And like the short-term rental, like loophole, they talk about cost segregation as a loophole. None of this is a loophole. It is a part of the tax code.
Exactly.
Right? Tommy called it a roadmap, right? You are using the rules as they are designed to be used, right? And specifically, shorter duration or shorter life equipment, those deductions allow for businesses or investors to reinvest, right? Those tax savings are legitimate. Those deductions are legitimate. And so it allows you to put more capital to work, to grow your business, to grow your portfolio, or whatever it is. And, that is the intention here, right?
Right. And I would really hammer down on the fact that it's not just reallocating them to shorter class lives, it's their appropriate class lives.
Right.
It's where they belong per the tax code. And then another thing on the short-term rental, it is 100% not a loophole. It is a pitfall. It is a trap. And if you hear some real estate broker telling you on TikTok that you need to buy your Airbnb, don't. And just know that there's more than 40 states at this point that are harping down on Airbnb regulations because the short-term rental market is trash. I don't know if anybody wants to hear that.
We see it all the time. I have so many friends that got into it, and it's a lot more work than you think it is. And to Justin's point, it's like you're usually working at the same time, and you don't realize you just picked up, a small hotel to manage. But, just going back to, because you mentioned Tax Cut and Jobs Act, 2017, the One Big Beautiful Bill coming out. This is kind of like where it gets tied all together, is like cost segregation is great, but the bonus depreciation side of this stuff is really interesting. I want you to talk about that, because a lot of people don't realize why'd you see so many car washes be built over the last, 7 years or so? It's because there's so many moving parts in them. They were primed for 100% bonus. Talk about the one big beautiful bill and how this ties together with bonus depreciation.
Yeah, I appreciate the question because it is the highlight of 2025 for our company. I think I had probably 30 clients waiting to see what would happen. So 100% bonus depreciation, and everybody's like, oh, I'm getting a big bonus. No, whatever we've allocated towards short-term property. So let's say, back to the $1 million property. So our $800,000, we separated the $250,000 into short-term property. Instead of taking that over 5 or 15 years in their quote-unquote appropriate class lives, what we're doing is we're accelerating that to the first year. Mm-hmm. And so that doesn't have to be first year of ownership. It's the first year in which you file. And we can get into 3115s, 41As, and all the other fun tax stuff. But in the first year, you're taking that $250,000. Now, let's say $100,000 of that is 5-year and $150 is 15-year. So now you're taking 1/15 of 150 each year, 10 grand, and then you're taking 1/5 of 100,000 each year, so 20 grand in deductions, as opposed to taking an entire $250,000 deduction in the first year. And there is this misconception with recapture, and I think I might have been light on this subject, so I want to make sure I reiterate this, is that at the point of sale, so let's say we own it for 5 years, that $250,000, whatever is allocated towards short-term property in your transaction is going to be eligible for recapture. The way that happens in a tax rate manner is the long-term property. So your, $450,000 of the $800,000, that is recaptured at a maximum of 25%. So if you're in Florida and you're paying the highest tax bracket, you don't have to worry about federal, so you're at 37%. So you have a 12% arbitrage in what you're actually paying back to the IRS versus what you took. And then for any of your short-term property, that's going to be taxed at ordinary income. And this is when the tax rate situation matters. Because a lot of people are like, oh, well, don't you have to repay that all in recapture? Wait till a year that you don't make money.
Right.
And then do it. Mm-hmm. Because your tax rate's going to be super low. You're going to be fine.
Right.
And you're going to love it.
And that's where the strategy and the planning comes back.
That's where it all matters.
Comes back in. And a lot of people that are in real estate do have somewhat lumpy income events, right? Liquidity events. So you can put, because a lot of times these people are not just W-2, highly compensated W-2 employees. Right. They are developers, right? They are doing acquisitions. They are doing value add. And so you can have these years where you're in lower tax brackets and, you can, again, play that arbitrage.
Right. And that's, and for everyone that's listening, it is really important who your CPA is. If your CPA isn't familiar with these things, that's okay. We can have conversations. We can get them up to speed because this shouldn't be their expertise. Right. If your CPA says they're an expert at 1031 or they're an expert at Cost Seg, they're probably lying to you unless they're just some hybrid that I've never met. But it's not, in most CPAs, and sorry to all my CPAs listening, are going to take personal offense when they hear from their client, oh, well, someone told me they can save me $250,000 and you never told me about that. So we try to be a partner with the CPA because Right. It takes two to tango, right? I'm not signing the return. They're not doing the engineering. We have to work together. So to everyone listening, make sure your CPA knows about it. And if they don't, have an open conversation about it. Set up a meeting with our company or with Fortitude Investments and have the open conversation because it's much better to educate now than on April 14th.
Yeah, we had this convo last time, and I think I might have been bashing CPAs last time, and I wasn't bashing CPAs. Justin made a good point, and we talk about it all the time. It's like a CPA, they can have 1,200, 1,500, 2,000 clients, and it's like that's so many people to deal with. And, they're doing the tax returns. They get so busy. People are asking questions late in the game, towards the filing dates and things like that. So, that's why it's, you're a great add-on or a bolt-on to the CPA firm. But, the client, like you're saying, they should be the one that's asking their CPA, hey, is this something that I should look into? Right. It's not the CPA's fault. They have so many clients that they're working with. It's hard for them to check every box for everybody.
Exactly. And all of their clients have different situations. Not everybody is a real estate mogul. Right. A lot of people have other complicated tax issues. So them trying to keep up with the, all of the updates on tax issues related to marriage, divorce, real estate, gambling, you name it.
There's been a lot of change recently too. I mean, it seems like the tax code every year.
Oh,
you know, COVID extensions and carry back, carry forward, Tax Cuts and Jobs Act, OB3, right? One big beautiful bill. And their knowledge base is expected to be so broad, so you can only go so deep on individual topics because you have to be so broad.
Right. And most people don't understand there's a difference between your CPA, your accountant, and your tax strategist.
Right.
Okay, they're not looking at 5 year forward going, what are you going to make? What's your tax situation going to be like? How can we make it better? They're going, how do I keep you from getting audited? Which is super powerful. You need that, but you also need someone to look forward to. And that's why you should sign up for the newsletters of Fortitude Investments and USA Cost Segregation, because we're going to keep you in the loop.
And I mean, it comes all back to the planning, right?
Exactly.
And I think you mentioned January 19th as being an important date and cutoff. Can you talk about that? Yeah.
So January 19th, 2025 is when the official 100% bonus depreciation starts. So if
when it came back.
Right.
With the OB3, right?
And remember that if you bought a property in 2022, you're going to have 100% bonus depreciation. It might have been 4 years and it's now 2026, but that was the rules on bonus depreciation at the time. So everything goes on your acquisition, your placed in service date for all of you accountants. And so anything placed in service after January 19th, 2025 is eligible for 100% bonus depreciation. Now, there is a confusion as to when that runs out. It is permanent. I'm here to say 100% bonus depreciation is permanent. What is not permanent is the qualified improvement property expensing relating to HVAC, new flooring, roof. There's certain things that are what are considered qualified improvement property, and those expensing regulations do run out on December 31st, 2029. It is not the same as 100% bonus. So 100% bonus, from everything that we can tell, is here to stay indefinitely. But this is now the golden age of tax mitigation in real estate. This is the time to buy properties, cost seg, do 1031s, build that tax can and kick it down the road, and really build a portfolio for yourself and make your money work for you right now while interest rates are high and you need cash on hand to make cash.
So powerful. So I think a lot of people might have the misconception a lot of this stuff goes into effect, Jan 1 next year. Right. But if you bought a property after January 19, 2025,
right,
that 100% bonus could be eligible to you or is eligible to you.
Exactly. And if you filed an extension, you still have time to do a cost segregation study without filing what's called a Form 3115 change in accounting method. What that is a form. So say you bought it in 2024 and you want to file for 2025 and your accountant took straight line depreciation in 2024. What we're going to do is submit a 3115 change in accounting method form and packet with explanations to the IRS that says, hey, we're going from straight line depreciation to modified accelerated cost recovery system, aka cost seg. And this is why it's let me slow down. It is not a very simple form, but we know it well. Mm-hmm. And we know how to put together the explanations. And we actually do this for CPAs because, back to the earlier point, they have a lot on their plate. Sure. And the last thing we want to do is add to that. So we do the Form 3115 and we do what's called a 481A adjustment. That is quite literally just an adjustment from the depreciation you did take and what you should have taken if you use cost seg. Mm-hmm. And it's a catch up. So that's why they call it an adjustment. And that is the form that is attached to the 3115 to quantify the change in accounting method.
So for folks maybe who purchased property going back to 2022, 2021, 2023, 2024, right, who maybe haven't done cost segregation studies, right? And that's kind of what you were just alluding to.
Right. So the phase out happened and started to happen in 23. So it went to 80% in 23. It went to 60% in 24. And it was going to be at 40% for 25, and it was going to be at 20% for 2026. So it was in what I would call a heavy dilution period. Sure. Thankfully, with the OBBBA, it's
OB3.
Always hard to say.
OB3,
I love that.
Yeah.
That's amazing.
Yeah.
The OB3. Oh, I love that. That would have saved me a lot of time.
Yeah.
So the OB3 brought back the 100% bonus depreciation. So it's almost like a deja vu from 2017 because it was kind of the same thing that happened where Trump came in and he brought back 100% bonus for the real estate investors. And when I tell you, I think that this is one of the biggest economical bumps that we could have gotten. I do not exaggerate. For the average person buying a $5 to $20 million hotel, and I say average and people are like, nobody's buying that. I got a lot of clients. I promise you, they are the guys that drive Honda Civics to school and they got 4 kids. They own every hotel that you've ever been to. This saved those incomes. And it's going to continue to save incomes, and it's going to create generational wealth for a long time with commercial real estate and residential investment property, because without cost segregation, without the benefits of 1031, you are stuck in a tax pit. And I think everyone, whether it's in real estate, whether you're a doctor, a nurse, a teacher, taxes are the burden. That is what changes your income from 100K to 40K, from 50K to 40K. It is a gap in what you need to support your family and what you need to grow your income. So if you're one of those David Ramsey person and you want to do 20% into your savings, that 20% is going to come out of the tax benefits you get from cost segregation and 1031s.
And folks that potentially purchased, right? I mean, to simplify, folks that potentially purchased going back 5-6 years, if you haven't done a cost segregation study yet, long story short, it's not too late.
Yeah.
Right. Reach out, right? And you placed it in service in 22 or 23 or 24. You can do a cost segregation study today. You can adjust the depreciation that you have taken and potentially now take your taxes owed to a tax refund.
Exactly. And, if there's even a question, if you think, I don't know if I have enough basis, it is free to send us an email. And we will give you an analysis. We will give you our thoughts. We will put it on paper and say, this is how much you stand to save and what it'll cost. So if you're listening to this right now, or you have clients and you're listening to this right now that you think this might be a good fit, it doesn't hurt to ask, and it's free.
Yeah, and I wanted to ask you that, right? So if someone's listening, a CPA, an investor, whatever, if this applies to somebody, what are the next steps for them? What should they do next?
And I appreciate the question. I always say it comes in 3. I need the purchase price, the purchase date, and the address. Mm-hmm. And that's it. So we actually have proprietary software. We have a data company, or a company in the data space, I should say. And we have pretty good access to information. So with those 3 data points, we can give you, I would say, within a 5% confidence level, what your deduction is going to be if we do a cost segregation. So if it's, a $5 million deduction that we're calculating, we're going to be in the ballpark within $50,000 of that $5 million. So it's pretty accurate. And that's free. That's just giving us the information saying, hey, I want to explore this. And that's the first step. And I will be the first one, and not a lot of people will do this, and I'd like to think that's what makes us special, is I will tell you, don't.
Right.
I will say, not worth it.
Right.
I sent an email right before I got here. It's not worth it.
I say that to people. People ask about 1031 exchange. They think, that they have to. And I'm the same. Yeah. It's not worth your time. Right. It's not worth the headache. Pay a little tax. Right. The freedom is worthwhile.
Exactly. And to that point, I also want to reiterate, this is not an audit risk. So just because you do a 1031 or just because you do a cost segregation study, you're not risking being audited.
Right.
However, you are creating another data point to look at. So I always say, if you're going to do it right.
Right.
And if you want something done right, it's going to cost money. So for everyone that's listening, there are people that will sell you a cost seg for $5,000. What I would like to poise is, if you can find an engineer and an accountant and an administrative team that will do anything for $5,000, you call them, tell them that I'm hiring and we'd love to have them. Otherwise, if you want to sleep at night and know that you're not going to be audited or opened up to any potential for being audited, you need to hire a team that's good for it. I'm not saying we're the only team that can do it, but I'm saying you need to pick carefully and you need to make sure they're professional, because at the end of the day, it falls on you. It doesn't fall on them. It is your responsibility as a taxpayer to make sure that you follow the rules. And we'll definitely hold you to the standard and we'll steer you in the right direction. But at the end of the day, you have to make sure you're hiring the right people to do this work.
And if folks are spending a little money for these cost segregation studies, and they are saving a lot of money on taxes that they would have paid otherwise, I mean, what's the ROI? If I'm paying 15 or 20 grand for one of these cost segregation studies, right? Some of your clients, right. What am I saving?
Yeah, so I'll give you a perfect example, actually. So we actually just did this deal recently. A large firm approached us. They do a lot of acquisitions, a lot of development, and they had a cost segregation partner they've been using for years. And I said, that's great. Let's just look at it. Let's kind of crack it open and see what's there. We found very quickly some issues with how they did their report, but more than that, let's say we didn't find any issues and their numbers were right, or at least to them they were right. We saved $1.2 million in deductions more. So if you're in Florida, 37%, that's over $400,000 in benefit that you saved. Our price different?
1.2 million in deduction.
Yep.
Times the 37% marginal tax rate.
Translating to around 400
some odd $1,000 of income taxes
money
paid
that you
got to
spend,
keep in your pocket.
So brand new Rolls Royce Cullinan.
Yeah.
That you'd have. Now the price differential on that was $7,000.
Yeah. Extra 400. So I paid an extra $7K
Crazy.
to keep an extra 400K.
Yeah.
It's pretty good.
So
I'm not going to do the math on that.
Would you trade me that check?
But that's pretty good.
Yeah, I'd like to think so. So, yes, we might be more expensive, but the benefit, the ROI is so insane in compounding. It's a no-brainer.
And I mean, you kind of mentioned it a little bit, and I felt you kind of get into it where this is like the beginning of another really busy time for you guys, right? You mentioned the January 19th, date, the 100% bonus. So, I mean, cost segregation is so powerful. The 100% bonus is so powerful. That January 19th date is so powerful. Where do you see all of this going?
Well, I'll tell you where I've seen what I've seen so far, and then I'll try to look through my crystal ball. So what I've seen so far is an intense buying frenzy. I've seen big firms that didn't have big plans for 25. As soon as this passed, they threw those plans in the garbage and they redrew the board. And now they're buying 30 properties this year because of those tax mitigation benefits.
Wow.
And it speaks for itself. The market has spoken that they are really excited about this. What I see in the future, especially with everything we have going on in the tax world, not including the tax boycotts, all this other crazy stuff, I see the sophisticated investor getting into a larger percentage. So the people that were, buying $5 to $10 million properties are getting way more educated. Part and thanks to AI and all these research tools that we now have, which please don't look anything up on AI and then call me with all the answers, because I promise it's not right. But it is at least getting people into the right mind. So I highly encourage it. Do all your research, but it's not always right. So all of that information compounding, we have people calling us all the time that have never owned real estate. They want to get in right now. They're like, I see the tax benefit. I see what I can do. My wife doesn't work. She has a lot of time to run our real estate portfolio, or I don't work and my wife does. I have a lot of time to run this. So maybe I could be a qualified real estate professional and take this off of their W-2 income. And I'm going to stop real quick, preface that statement, because we never did mention this. If you file jointly with your spouse and one of you qualifies for real estate professional status, you can take it off both W-2 incomes. So if one person is managing the real estate portfolio and the other one is managing the dental office or whatever it is that you like to do for a living.
Or the household.
Yeah, or whatever the case, yeah.
Yeah.
As long as one person qualifies under that test, it can come off of all of your ordinary income as a couple. So huge thing. Make sure you split your time wisely, but you can't combine time. It's got to be one person doing it. Can't combine it. Where were we?
Well, we were, you're talking about spouses, wives, you just got engaged.
Oh, man.
Congrats.
I did. Thank you so much.
Yeah.
He needed that active income, right? That active that real estate professional status. You had to go find yourself a wife who could qualify, right?
For all you gentlemen that are single, you have the tax mitigation strategy right in front of you.
Just get married.
You just have to marry it. No, I kid. She's actually the vice president of our company. So this is going to be fun when we all listen to this together. Unfortunately, we both qualify for real estate professionals. So we're fine. But yes, this is a big thing for those couples that, maybe one person's at home and they have more time on their hands. Dedicate your time. Make sure you're taking copious notes and you have documentation to support it. The IRS is not going to take your word for it. They're not going to go, great, love to hear it that you're a real estate professional now. We'll just take all this money off of your taxes. No, they're going to ask you questions, or they'll ask your CPA questions, and maybe they won't, but there's more than likely, right? More likely than not, So make sure that you have your documentation. Make sure you're consulting your CPA, a cost segregation specialist, your tax professionals to make sure you're doing it right. Don't just shoot in the dark and show up in April and ask us to handle it, because it's probably not going to be easy. But there is so much that you can do right now to get ready for 26, especially those that are married, filing jointly. Look at your time for the year. If you maybe need to put a little bit more time towards commercial real estate, do it. It's worth the benefit of taking it off that W-2 income.
Well, Richmond, USA Cost Segregation, it says it right there in the name. We were really looking forward to this, man. We appreciate you coming down for this. This was a topic Justin and I were really excited about. We talk about it all the time, and it's just really undereducated, to the masses. And we asked you to come to town, jumped in the car from Greenville, South Carolina, and headed down with your fiance down to West Palm with us to sit here. Thank you, man. Thank you for being here.
Thank you for having me, gentlemen. Justin, Tommy, it's been a pleasure knowing you guys. It's been a pleasure working with you guys. And it's always a pleasure to come down to West Palm Beach and Palm Beach Gardens and enjoy the beautiful view.
Well, getting towards, the end of the year here, we might need to do a part 2, have you back on, because I just see the frenzy, picking up with this. You just kind of alluded to it. How many people
will not have a hard time getting me back.
Yeah.
Maybe not over the summer down here in West Palm, right? But
I sweat in the winter. And for anyone that's listening, if you'd like a free evaluation, if you'd like us to look at your tax portfolio and see what you can do, feel free to email info@usacostsegregation.com or visit our website, wcostsegregation.com. There's a link in there. You can schedule a meeting with one of our experts for a free evaluation. Thanks.
Richmond, you're the man. Thanks for being on here today with us. We appreciate it. And guys, if this applies to you at all, Richmond, USA Cost Segregation.
Gentlemen, thank you so much.